This is Brandon Steele. Welcome to the Mainsail Financial Group podcast series, where we host industry experts and local professionals to really help share some insights into areas that we don't get a focus on necessarily day to day. Today we want to thank Doug Perry for joining us. Thanks for coming out. Doug's actually a branch manager for Wallach and Volk Mortgage Brokers. They're located just right here in Bellevue, correct?
Correct.
Okay. Doug tells me they've been around since 1933.
Correct.
So one of the, if not the oldest, oldest mortgage brokers in the nation, right?
Yes.
Okay, great. And Doug's been a top loan originator since he started back in 1986, if
Correct.
I remember correctly. Great.
Yes.
Perfect. Well, I think with where interest rates are and the housing market here in the Bellevue, Seattle area, couldn't ask for a better time to kind of have you on and share some insights. So thanks again for joining us.
Yeah, thanks Brandon for having me.
Yeah.
A lot of dynamics out there right now. As far as the housing market goes, inventory is at its lowest levels that it's ever been.
Mm-hmm.
So we were experiencing tremendous appreciation over the last few years. Last year or two, it's leveled off, consolidated. Now expect appreciation to start heating back again.
Interesting. Okay. Lowest levels it's been, huh?
Yeah,
That's
it's incredible.
surprising.
It's just insane that way. And then in conjunction with the lowest interest rates or mortgage rates are the lowest levels that they've been in over 3 years now.
Yeah.
Who knows what's going to happen from here, but likely we'll see lower rates as well.
So all adds up to I guess a good housing market.
Yeah.
Interesting. With that, so actually to kind of get off track a little bit with the inventory side of it, does that include some that are being built, or how's that calculated exactly?
Well, that's a problem. It's a supply and demand situation, and builders can't get the homes built fast enough.
Mm-hmm.
And especially around the Seattle area, there isn't enough land.
Right.
And so what you see is prices, especially closer in areas, will just go higher and higher with the supply and demand.
Okay, crazy. Gosh, it's just like they just keep building, but it's not keeping up. It's
No,
amazing.
and all the people, people are moving here. Seattle's a very desirable area.
Mm-hmm.
You have tremendous employers, hiring people and bringing people in worldwide.
Sure. Yeah, there's a few of those around here.
Yeah.
So let me ask you, so to come back to the interest rate discussion, so obviously we are low. May not look, from my perspective, like we're going up anytime soon.
Right.
What's your take on where interest rates are and kind of what you see ahead?
Yeah, I see interest rates still continue to fade down. They've been fading down. We're in a long-term downward trend in rates.
Mm-hmm.
There's a point where can rates go any lower? Sure. You have negative interest rates in a lot of the countries out there. There's even a couple negative interest rates on mortgages in the European Union.
Yeah.
Crazy. So you get a mortgage and the lender pays you to take the mortgage.
Gosh, I hope we don't go there.
It's a crazy. That's a crazy thought in a crazy world. But that's that may be something that we're in right now.
Mm-hmm.
There's just no inflation out there, and you'll see interest rates continue to go down. And in conjunction with the hot housing market, values are going higher, and it provides people a great opportunity to reposition debt,
Absolutely.
take advantage of better financing, when they have homeowners, and just a case in point on that. I talked to a client yesterday about their possibility of refinance, and they bought their home about 7 years ago on an FHA 3.5% down.
Mm-hmm.
They invested like $6,000-7,000 to buy the home. Now they have about $250,000 worth of equity.
That's amazing.
What a great return.
Yeah, no kidding.
What a story.
It's funny, that's actually one of the things I really wanted to talk to you about is, to that point of interest rates being so low. I'm assuming you probably get a lot of refis going on right now.
Mm-hmm.
Is that fair?
Correct.
So what is maybe a rule of thumb where somebody should start looking at refinancing and to kind of carry along that? Some things they should consider or look out for, I guess, in that process too.
It's a very situational thing. It depends on the family. It depends on the family's objectives. Everything's different, and there's it's hard to say that there's a rule of thumb. Refinancing just on simple interest wise dollars in, dollars out. What's it cost and what's the benefit over time?
Okay.
My favorite position is to arrange the financing to make refinancing a no-brainer, where the future is always uncertain.
Right.
You know, it's hard to know how long a family's going to stay in the home.
Mm-hmm.
It's even harder to know where interest rates are headed.
Yes.
And especially if they're headed down, you may be an opportunity to refinance in 6 months from now and benefit again. So my favorite positioning on that is to do the financing without having a client incur any costs.
Okay.
And so you do that as a result of increasing the interest rate to essentially finance the closing costs into a little bit higher interest rate.
Yeah.
But it's all relative
Interesting.
based on what they have currently.
Yeah. And I know we were talking about this a little bit offline too, and I think that's a really good point, because I think so many people shop around for interest rate.
Yeah.
Right? But that's a huge thing that might be missed, is the flexibility.
Dollars in, dollars out. If it doesn't cost anything and it's a significant benefit, it's a no-brainer.
Yeah. Is it fair to say then that typically, if you look at refinancing or mortgage in general, well, let's say refinancing, the more cost up front, the lower interest rate, the less cost up front?
Correct.
Okay.
Right,
Great.
right.
Okay.
And that's a sliding scale, and and to think of that, the lower the interest rate, the more equity you have to use in order to refinance.
That makes sense.
And so that's that money that you're putting at risk. What happens if interest rates fade down by another 0.5 percentage point in 6 months' time?
Yeah.
That money that you're spending on costs is at risk.
Yeah, that makes sense. Okay. And I guess along those lines too, with the differences, I guess the differences between fixed rates and ARMs, can you maybe speak a little bit to that, some of the risks that you see, speaking of interest rates and...
On an ARM, and it depends on the loan amount size as well. And when you're talking about maybe in the jumbo arena, something in the mid-sevens or higher, an ARM can be a really attractive way to go, especially if everyone anticipates low interest rates for the foreseeable future. And so that's a great way to go. What's the risk? The risk is you get to the end of the 5-year or 7-year or 10-year term, and it rolls into even lower interest rate at the time. So again, it's hard to know, but there's a chance that the economy gets going and interest rates happen to be higher at the time.
Sure.
So that's your risk.
Yeah. Okay. And how does that differ outside of just obviously the interest rate? But what are some things folks should look at if they're exploring that? Should they consider how long they're going to be in their home?
Right. It's it's kind of a guarantee. If someone is looking only staying in their home 5 to 7 years, because of work or they're going to grow out of their home, an ARM is a really good way to go. It's a good option versus a 30-year fixed.
Okay, that makes sense. But then, of course, it comes back to what we were talking about earlier, right? Who knows?
Who knows?
What's ahead?
And it's just balancing those risks and what are the rewards in taking that risk.
Yeah, that makes sense. Okay. On the flip side of that, looking at how folks can finance these these homes, whether it's a new home, first home, whatever. What programs are out there to keep your down payment as low as possible?
We have some. The state has some really good bond programs. They kind of mirror the FHA type of loan or conventional type of loan, where you're 3.5% down or 5% down conventionally or 3% down conventionally. Then they also have funding for second mortgages that are sometimes even forgiven. So you could go in and do a 3.5% down and get a 4% down payment assistance loan that acts as a second mortgage in behind that. So you don't need to have the money. You don't need to have money to buy.
Right. That's interesting. Well, I guess that goes back to your example earlier, right?
Right.
$7,500 down or whatever it was.
Yeah. As long as you're comfortable with the payment, because you're borrowing that much more, you're highly leveraged. But it's one where if you anticipate earning more in the future, and it's a starter home, it's a great way to build wealth.
Yeah, that makes sense. How do these loan programs differ from, I don't want to say a first-time home buyer, but let's say a primary home, as opposed to a rental or investment property?
The down payment is the significant part. For an investment property, normally you need 20 to 25% down. versus your owner-occupied home, again, 3.5, 5% down. The interest rate for an investment property is commonly almost a full percentage point higher than the owner-occupied rates.
Wow.
And one of the common topics is someone who bought their starter home now is growing out of it. Now, should they sell that home, or should they go ahead and rent it and then buy a new home?
Sure.
And how do we best position that?
Yeah. So you see a lot of people maybe refinancing or doing something when that happens.
Yeah.
Okay.
Yeah. And then maybe getting a home equity line of credit to tap some of the equity, so that they have money to put down, and then renting out the home, thereafter.
Yeah. Okay. It's funny. That's another area I really wanted to cover today. So along the lines of the refi, I'm sure you're seeing a lot of HELOCs taken out as well, home equity lines of credit, right? So can you maybe speak a little bit about that, whether it's used for that scenario or remodels? I mean, just what a HELOC does and where it might be considered.
Home equity line of credit is a great financial tool. It's there. It doesn't cost very much. You commonly only pay interest on the amount that you have outstanding, and you have a line of credit, just like a credit card, where you can get advances. You can pay as much of the loan off as you want. You can pay it off entirely, and the line of credit's still there, and so you can use those funds for however you wish.
Sure. And that's a fixed rate, right?
Once you they normally, there are versions to that, but they do normally float with prime.
Okay.
And depending on what the loan to value is, what the credit scores are, will dictate prime plus something.
Sure.
Okay. They're commonly at prime plus half, prime plus 1,
Great.
something
So
in that neighborhood.
favorable rates for sure.
Prime right now is at 4 3/4, likely to go down to 4.5 this summer.
Okay. Yeah, especially with interest rates so low, I think that's a huge opportunity because you don't have to use it either, right? So you can take this line of credit out, just have it available.
Just like an insurance policy.
Yeah, exactly.
Yeah, things happen.
Yeah, exactly.
Where opportunities knock.
Right, and then you can get your money pretty quickly as well.
Exactly.
Yeah, interesting.
Right.
So I'm going to switch gears here quite a bit, but 2008 I think is still very exciting, very fresh on people's minds. For better or worse, I guess. But one of the things that I think is starting to come out of the media, maybe in the last year or so, is that it seems like they're talking more about the mortgage market and potentially, people kind of defaulting on loans and maybe taking on more risk than they should, the mortgage industry. Curious your thoughts on where the mortgage industry stands and, what you see ahead there.
Well, we're nowhere in the 2008 realm of mortgage financing. That was a time where if you fogged a mirror, you could get $1 million to buy a home 0 down. There's nothing like that in today's world. Those type of loans propelled prices artificially.
Yeah.
And so we don't have that. There are more creative programs coming online, but you need to have good equity.
Okay.
And they're sound programs. There are some more of the no income verification loans that ruled the 2008 time period coming back, but really more so on the investor side of things.
Oh, interesting.
So if you're buying a home and the property cash flows with the potential rent that's coming in, you can get financing.
Okay.
But again, it takes a significant down payment. It takes that 25-30% down payment.
Right. So if you can come up with that, that's kind of the justification.
Correct.
That makes sense.
Yeah.
Okay.
So it's as far as lending goes, that's a good business decision because there's a lot of cash invested in the property, and borrowers commonly aren't going to walk away. The challenge with 2008, the families weren't vested in the property. They didn't have any money into it or very little money into it, and it was easy to walk away.
Yeah, that makes sense. Well, and you brought up earlier the supply and demand side of it, and it sounds like from what you're saying that the housing prices back in 2008, a lot of that was propped up by these bad loans and people just being able to buy, multiple houses they couldn't afford.
Mhm.
Whereas now, it's not people buying multiple houses, it's there's not enough houses for the people.
Right.
Is that fair to
right,
say?
Right,
Okay.
right.
So much healthier market then. essentially.
Much healthier market.
Okay, that's good to hear.
Yeah, and so I don't anticipate any, weakness in the housing market,
Mhm.
at all.
Okay.
Especially in the Seattle area.
Yeah, well, I'm sure that, the big tech companies are helping out a little
Right.
bit with that too, that you
Right.
mentioned earlier. Okay, so one of the things we run across quite a bit with the ability to keep your down payment, as minimal as possible is primary mortgage insurance or PMI.
Mhm.
Can you maybe speak to that a little bit? When it comes into play, how much it typically costs, and when you might, I guess, consider doing the 20% as opposed to less?
And that's, really, if you have that choice, it's a matter of positioning your assets.
Mhm.
And that's something that you could, best advise on. Mortgage insurance is a okay, situation.
Mhm.
And it's one where if you're able to buy a home sooner, than later, because you have more minimum down
Mhm.
versus needing to have the 20% down, eliminates the necessity for the mortgage insurance.
Mhm.
So you have those options, and mortgage insurance will drop off over time.
Yeah.
As soon as you pay the loan down to 78% of the original value, the mortgage insurance will fall off
Okay.
automatically.
Yeah.
And so that's, you have